I think the reason we see silver moving up is because of simply people want to make more money. Silver moves faster. They're like, okay, well, if precious metals are going higher, give me the fastest moving one you got. Silver happens to be it. People always gravitate to where can you get the most leverage, make the most money. Silver's always been that. That's why there's silver stackers dedicated. They're like, silver's going to go to 100 or $500, and that's what people are stacking for, is when the system breaks and silver goes ballistic. What I see is there's usually a 3 to 4 day window. So you have a down day like today, a 4 or 5% down day, and that wreaks havoc and echoes through the people who are holding silver, who are potentially going to sell if it moves down too much. The working class, they come home tonight, they come home, they sit down, they look at the markets because they're working all day, and they're like, holy crap, silver sold off today. Well, short-term traders already got out today. For major trends, gold moves first, and then silver's a little delayed, but then silver will play catch up on the back end, which is what it's doing right now. Gold got the attention, it got the love, and then suddenly gold's having a pullback and a pause, but now everybody is on high alert that precious metals are a hot sector.
Notice that gold has been flat, if not up, in the last month or so. Over the last 3 months, gold is actually slightly down by the order of, I think, 1 or 2%. And silver is a completely different story. Silver is actually up by a lot. So yeah, gold peaked around October 20th, 43.74, and we're still right under 4,300 right now. So it's slightly down in the last month and a half. Silver has been up, let me just pull up the exact number.
Yeah.
There we go.
Yeah.
So that doesn't typically happen. They move in the same direction, but then flat for one and then up for another is not the same direction. So what do you make of this divergence?
Yeah, so the precious metal space, gold has been on fire for a long time. It has been kind of, while silver traded sideways for a year, gold actually just kept moving higher. So gold has had a lot of attention. Enough momentum got into gold that people then eventually bled over into silver. A lot of times I find for major trends, gold moves first and then silver's a little delayed, but then silver will play catch up on the back end, which is what it's doing right now.
This divergence looks calm on the surface, but it's quietly revealing where speculative capital is rotating. Gold being down roughly 1 to 2% over 3 months, while silver surges, isn't random. It reflects a classic late-stage behavior, where investors chase momentum, not safety. Historically, as Chris Vermeulen has pointed out, gold often leads early cycle trends while silver lags, then accelerates once risk appetite increases. The key issue investors miss is timing. Silver's catch-up phase often coincides with stretched sentiment, not fresh fundamentals. Portfolio-wise, this matters because divergence doesn't signal strength across metals. It signals concentration of risk. What Chris Vermeulen explains next shows why this shift may not be as bullish as it appears.
And so what I think gold got the attention, it got the love, and then suddenly gold's having a pullback and a pause, but now everybody is on high alert that precious metals are a hot sector. Because we're seeing miners breaking out, we've got silver, platinum, and palladium. Everything is taking part, not just gold. And so I think the reason we see silver moving up is because of simply people want to make more money. Silver moves faster. They're like, okay, well, if precious metals are going higher, give me the fastest moving one you got. Silver happens to be it. Silver also happens to be a much smaller market, I think, than gold. So it doesn't take a whole lot of more money to go into that space to make it go even higher. And so silver is just getting juiced right here because money's moving into it and saying, you know what, forget slow gold right now. I'm going to go into silver. And so silver is getting the attention. And it's, today, I think you and I are speaking, it's down about 4% alone.
Yeah.
But that's typical for silver in this type of environment. We got big up days, up 4 or 5%. Other days it'll be down 3 or 5%. That's just the nature of that beast because it's a tiny market.
When markets say broad participation, this part exposes what's really happening. Capital is chasing speed, not conviction. Silver's smaller market cap means relatively modest inflows can cause sharp price spikes, but that same structure amplifies downside volatility. Historically, silver's daily 3 to 5% swings are a warning, not a feature, especially when miners and related metals rally simultaneously, a pattern seen near 2011 cycle exhaustion. As liquidity tightens and the Fed stays restrictive, fast-moving assets tend to overshoot fundamentals. For everyday investors, this isn't diversification. It's crowd behavior disguised as opportunity. Next, Chris Vermeulen connects this acceleration to a much bigger cycle risk most traders ignore.
It moves fast, but it's the favored one right now. People always gravitate to where can you get the most leverage, make the most money. Silver's always been that. That's why there's silver stackers dedicated. Like silver's going to go to 100 or $500, and that's what people are stacking for is when the system breaks and silver goes ballistic. And so yeah, silver just becomes that play later in the stages. That to me is telling me we're getting closer to a major top in the precious metals space. I still think there's another 40, 50% or more for silver to the upside, but it's telling me now people have shifted from boring gold to be more secure. Now they're willing to put on more risk. And that's a little bit of a sign that it's starting to mature, this trade.
If you look at how silver's performed over the last 2 months, the sell-offs have been pretty consistent in what follows in terms of the magnitude of the sell-off and then what follows after that. So every time silver has fallen by more than 4 to 5% in a single day intraday basis, the sell-off continues for a few more trading sessions before the sell-off starts to decrease in magnitude and the price stabilizes, consolidates for a while, then it goes back up. It's been pretty consistent.
This is where optimism quietly flips into late cycle risk-taking. The narrative of silver going to $100 or $500 thrives when fear of missing out replaces capital discipline, a pattern seen before the 1980 and 2011 peaks. While upside potential remains, the repeated 4 to 5% drawdowns followed by multi-day selling suggest emotional positioning, not institutional accumulation. As analysts like Chris Vermeulen have warned, late-stage metals rallies often reward patience more than leverage. For investors, this phase demands position sizing, not conviction stacking. Risk is rising even if prices aren't done yet. What Chris Vermeulen says next explains why short-term drops tend to snowball.
So it's funny because I had a guest on yesterday and I was telling him, this was before today's big move, of course, and I was telling him I would maybe make a pair trade short silver and long gold. I don't think that's worked out because both of them are down today. But my point was that silver looks a bit more overbought relative to gold on a technical basis. And so I'd just like to comment on both of those points that I made. So first, which is that a 4 or 5% sell-off in silver in one day has usually been followed by further sell-off. So maybe evaluate that. And then second, does it look a little bit too overbought, even at current levels relative to gold?
Okay, yeah. So silver is it's fast moving. Fast moving means increased volatility. Increased volatility means more emotional traders involved, right? So when silver's had a big run like it has had here, it's had a beautiful pop and run. It's very quick and easy for it to pull back and to shake people out. And generally what I see is there's usually a 3 to 4 day window. So you have a down day like today, a 4 or 5% down day. And that wreaks havoc and echoes through the people who are holding silver, who are potentially going to sell if it moves down too much.
This is a textbook volatility trap that catches short-term traders repeatedly. When silver drops 4 to 5% in a single session, history shows follow-through selling over the next 3 to 4 days, as different investor timeframes react, from day traders to retail holders checking charts at night. Technically, this aligns with exhaustion patterns seen near prior cycle highs, where upside momentum fades before price collapses. Pair trades sound sophisticated, but as volatility spikes, correlations rise. Both legs often lose together. For investors, the lesson is clear. Speed magnifies emotion, not protection. Next, Chris Vermeulen reveals why hedging often fails when it's needed most.
The people who are open to selling because they're worried, they're very short term, they're going to sell. And it usually takes about 3 to 4 days. So silver sells off. Well, there's going to be, the working class. They come home tonight. They come home, they sit down, they look at the markets because they're working all day. And they're like, holy crap, silver sold off today. Well, short-term traders already got out today. Like we're talking day traders, momentum traders. But then they're going to see it at night and they're going to be like, well, on Monday, I'm getting out because it looks like it's topped. It does have a little bit of an exhaustion pattern. It ran higher this morning and is closing below yesterday's low, which is not, that to me alone is saying we're probably going to see a few more days of downward price. So I think you've nailed that part, David. And then, of course, there's people on the other side of the world that eventually see this move, and then they got to take action for their first day, and then they see it, and the next day, other people get out. So there's different time frames of people, investors who are going to panic out. So I think when we see a sharp move, especially in a volatile asset, it sparks emotions, and then it takes about 3 or 4 days for that fear to finally work itself out.
This isn't just price action, it's the psychology of retail panic unfolding on a clock. What he's describing mirrors volatility studies showing most retail-driven sell-offs peak 3 days after an initial shock, not on day one. As Chris Vermeulen has noted, emotional exits tend to lag institutional moves, creating rolling pressure instead of a clean flush. The exhaustion signal he mentions, closing below the prior day's low, historically increases downside probability in high beta assets like silver. For investors, the danger isn't the first drop, it's assuming fear finishes quickly when it rarely does. Next, Chris Vermeulen explains why even bargain buying can make losses worse.
Usually after a big down day, there might be a little bit of a pause or bounce, and that's simply bargain hunters stepping in saying, oh yeah, it sold off way too quick. But usually that overall drip of selling pressure from all the different layers of investors from around the world will carry over and drag it down a little bit more. Your other question, David, I'm trying to think of what it was. You were talking about
gold relative to silver, vice versa. Silver relative to gold, whether or not silver just looks really overbought compared to gold. But I think you covered some of that already.
Yeah, and you're kind of talking about the pair trade. So I'm not a fan of hedging. I used to hedge years and years ago, and I realized hedging costs money. And then a lot of times it's really hard to time the markets. So you put a hedge on, and then you realize the asset you were holding and hoping was going to go higher. You put a hedge on to protect it. Your asset keeps going higher, and then your hedge just costs you money. So to me, I feel like a pair trade is kind of like a hedge. I'm like, and my other theory is if the precious metal space is going down, if silver is going down, gold's probably going down. If the stock market's going down, or say technology, I'm not going to pair it with another sector because I look at the precious metal space as one trade.
This is where well-meaning risk management quietly backfires. Short-term bounces after sharp drops often lure in value buyers, but data from past silver corrections shows these pauses rarely mark the true low. His critique of hedging matters. Studies show poorly timed hedges can reduce returns by 2 to 4% annually without meaningfully cutting drawdowns. As markets tighten and correlations rise, pair trades stop diversifying and start compounding losses. For everyday investors, the takeaway is simple. Complexity doesn't equal protection, especially in fast-moving cycles. What Chris Vermeulen says next challenges one of Wall Street's favorite safety myths.
They generally move up and down together. And same with the stock market. So I stay away from pairing, stay away from hedging. It's just an expense. You're then trying to time some move you think is happening. And I think you're better to just either ride out the volatility and not put the hedges on, or exit it and get back in once you're confirmed that it's starting another uptrend.
This cuts against a massive industry narrative that sells hedging as discipline. In reality, correlation spikes during stress events, exactly when hedges are supposed to help, as seen in 2008, 2020, and 2022. When everything moves together, timing becomes the only edge, and most investors don't have it. His point is uncomfortable but practical. Risk is often better managed through position size and patience, not financial engineering. For long-term portfolios, avoiding constant defensive trades can preserve capital more effectively than chasing protection. Next, Chris Vermeulen zooms out to the cycle that makes this decision unavoidable.
The next cycle high is this coming year, 2026, and all the analysis that I've always shared with you, David, has been saying like something big is coming, something bad is coming. The thing is, we don't know when. The markets can drag things out much longer than you anticipate. The key is to make sure you've got a game plan. This cycle is saying we could have weakness at some point in 2026. Maybe it drags over to 2027. Maybe the markets still hold up next year with some QE. I'm not sure, but you need to be prepared because when this does happen, we could see a weakness all the way down to 2032. So that's a long ways away. It's a long time to be losing money, having businesses downturn. But this is all an opportunity. When the markets do correct, 2032, or when my analysis shows that the markets are turning and things are starting to strengthen, man, If you can survive a market crash and a reset and you have your capital and you can invest it in ways that will make you wealthier so fast than anything else, you can just move into multiple things. So that's what this cycle plays into.
This is the part Wall Street never markets. Long cycles don't care about patience narratives. Extended drawdowns, like 2000-2013, destroyed capital not through crashes alone, but through time. His warning aligns with secular cycle research, showing real returns often stagnate for a decade after major peaks. QE can delay pain, but it rarely eliminates it, something the Fed learned post-2020. The opportunity he mentions only exists for investors who protect capital early, not those fully invested at the top. What comes next explains how markets signal that reset before headlines admit it.
It's a very big analysis. It's not always accurate. It hasn't nailed everything. It's just interesting because it falls in line with the most recent cycles that we've experienced as traders and investors. And the next one happens to be starting in 18 days from now. The year starts. The ticker, the timer is going for this cycle to find a top in the coming year.
Let's overlay maybe this chart. I'm just thinking about this. Maybe overlay this with an actual price chart, and then we can talk about indicators you're looking at for rollover, because what that's showing you is a local top sometime in 2026 if markets follow this chart.
Yeah.
And then at some point in 2026, markets start rolling over. And back to the age-old question: how do you tell when the market's starting to roll over, or if it's a one-day correction?
Well, you got to follow things on multiple time frames. I mean, we can go and look at a long-term investing chart here of the weekly chart of the S&P 500.
Cycle models feel abstract until you realize markets have a habit of topping when confidence is highest, not when fear appears. What matters here is alignment. This cycle projection lines up with recent liquidity, valuation, and sentiment extremes rather than standing alone. As Chris Vermeulen often stresses, single-day pullbacks mean nothing without confirmation across weekly and monthly charts. The S&P 500 weekly time frame historically catches structural rollovers months before headlines do. For investors, the risk is confusing short-term noise with long-term inflection. That mistake costs years, not days. Next, Chris Vermeulen explains why major bear markets are only obvious after damage is already done.
And so if we go back to as far as this chart loads, this type of analysis tells us, when we're finding a major bear market top, when there's a new bull market starting, and it gives us these windows where these kind of colored arrows are of when to be protective of ourselves, because you just never know when one of these big resets are coming. So we'll be looking at the weekly chart, the long-term investment signal, saying, okay, are we coming into a 2007 market top? Do we have the divergences? Do we have price starting to break down? All of this stuff. And so it's hard to identify a major bear market because the reality is you don't know, for example, that this is a full-on bear market until it really puts in, has a 20+% drop, and then it finds stability, and then it breaks down from there and then goes into like the 30, 40, 50+% correction. So that's what we need to see. Like, for example, if we look at 2022, the stock market pulled back 20+%, and then it kind of went into this consolidation. Now, if this broke down and broke this low, then we would probably be starting a massive bear market, a multi-year bear market. But
this exposes a truth Wall Street avoids. Bear markets are only labeled once investors are already trapped. Historically, the average S&P 500 bear market decline is about 36%, yet most investors wait for the first 20% drop as confirmation. As Chris Vermeulen research shows, the most damage happens after failed rebounds, not during the initial sell-off. The 2022 example is key. Consolidation saves sentiment, but a breakdown would have changed everything. The real signal isn't headlines, it's failed recovery attempts on weekly charts. What comes next explains why false bottoms are so dangerous.
But it ended up carving out a bottom. It ended up generating a new strong trend to the upside, and we're back into a trend. So for us to know when we're going to have to see like price break down and have a correction, and then eventually kind of break another significant low. And then from there, it can go into a big waterfall. So we're going to have to look at it from different time frames. We'll probably see the stock market sell off in a big way. And we'll probably see precious metals initially have a very big rally and move higher. And you and I have covered this before, the comparison chart of 2007. And if you take a look at the chart on the left here, the stock market was trading at all-time highs. Gold was pushing to all-time highs. It's right where we are right now in real time. Similar type of setup. Both stocks and metals rallied together for the last couple of years. What I'm looking for eventually is the stock market to break down, and the money is going to come out of the stock market and it's going to shoot and get pushed into the precious metal space. So
this is where timing illusions hurt long-term investors the most. In 2007, stocks and gold peaked together before capital violently rotated, exactly the pattern being flagged here. Research from Howard Marks reminds us that trends don't end cleanly. They fracture after failed lows. A sharp equity sell-off paired with a metal surge signals fear, not safety. For portfolios, this means metals. Strength may confirm stock weakness, not hedge it forever. Misreading that rotation can lock investors into the wrong side of the trade. Next, he outlines the signal that marks the real end of the cycle.
when we see this, David, when we see stocks crash and all that money comes out of stocks and people push it into the precious metal space, where gold could rally another 15 to 20% from here, silver could rally another 50 to 60% from here, same with platinum, same with palladium, that to me is going to be like, okay, now it is like, this feels like the end. The music has stopped for the stock market. And eventually the stock market will put in some type of pause. And then when it breaks those lows, that's when we go into like a stage 4 decline and the bottom falls out and there's mass devastation for businesses and bankruptcies, and gold will pull back with that. So that's what I'm looking for, is this extreme divergence where metals shoot higher, everybody loves it, and people start moving out of gold. That to me will be like one of the last indicators saying, hey, we only have a couple months left and we could be entering a big reset and a recession in the economy, global economy.
Yeah, that's the key, because when stocks enter a huge bear market, typically gold and silver fall with it initially, at least.
This is the uncomfortable finale most investors never prepare for. Late cycle metal euphoria often marks exhaustion, not safety. In 2008, gold dropped nearly 30% after stocks broke down. A 50 to 60% silver surge would likely coincide with panic flows, not sustainable demand. As liquidity dries up, everything gets sold to raise cash, including safe havens. The signal isn't metals rising, it's metals being abandoned after the surge. That's when resets turn brutal and policy tools lose control. What follows is the hardest phase for capital preservation, and the most ignored.